All right. Hi. My name is Mike Sorrentino. Can we hear me okay? All right, excellent. So I got a lot to talk about tonight. Good news, bad news. Good news, brand new presentation, new material, state of the markets, figure out hopefully what happens next year and the years beyond there. The bad news, I have no idea how long it's going to take. So I'm going to try my hardest to keep on track. If I look down at my watch, don't think I'm being rude. I'm just trying to make sure I keep us on track because I don't want to keep you here till 9 tonight. That's a joke. It's not going to be that bad. But that being said, quick background on myself. I have spent quite a number of years in finance and investing. I came from the sell side, what's the institutional side of this business, where I spent a number of years working for two of the premier equity research firms in the world. I've been a chief investment officer overseeing close to $7 billion in assets under management, and I got a lot of degrees and stuff like that that you need to have to work in this business. So I'll skip on that for a little bit. I want to spend more time on what I know it's everybody's mind right now. The number one question, why everybody got here tonight, what's the market going to do next year? I'm asking. Up or down? Stock market, up or down? Up? All right. Yeah. A little bit of this? Okay. A little bit of that? Down? All right, I'm not hearing a consensus yet. I see another up. All right. Can we safely say it's probably going to be up? All right. Some people might disagree there. All right, how much? 3%. Our long-term average is right around 9.8% over the last 25, 30 years. Above or below the average? Below? Okay. I'm asking for, because I really would like to know. If anybody knows, I mean, it would be a real big help for me considering what I do for a living. Look, I'm going to be very honest with you. I have no idea what the market's going to do next year, and I really don't care. All right, so you might be wondering, why did I just show up to this event when the guy up here talking is telling you have no idea what's going to happen in the market? Well, there's a number of reasons for that. So I just realized that there's a couple colors that might look funny on this presentation because of this projector. Don't worry, I'm going to walk you through everything. So let me tell you why I don't care, why I don't know. And I say with pride and confidence. So there are about 13 of these large Wall Street banks, these institutional banks like Goldman Sachs, Morgan Stanley, the big names, right? So each one of these firms hires somebody called a chief market strategist, all right? Now this person's goal, their only job is at the beginning of every year is to figure out what the stock market's going to do at the end of the year, okay? So they come out with this forecast typically right around this time of year, December into January of the new year, and they publish what they think is going to happen. Now these people are incredibly smart, all right? They get paid millions of dollars a year. All right, they have a team of really smart people running around doing whatever they're told to do. They've got budgets that give them access to unlimited data, and they work so many hours they don't know their kids' names. All right, so I used to work with one of the top strategists in the world, and I used to make fun of him because this guy, he worked at my company. He had a cot in his office because he slept there 2 to 3 days a week. He didn't want to take the train back to Connecticut. So these are the types of people we're dealing with, okay? So what I did was I went back 18 years, from 2000 to the end of last year, and I took each one of these estimates, these 13 really smart numbers, okay? The estimates, the forecast for the S&P 500. I took 13 of them and I averaged that together to get one number. Does that make sense? Each year, that is a very well-informed number. Think about all the money, time, resources, PhDs, everything that went into that number. I then took that number and I compared it to the actual return of the S&P 500 each year. Now, I know you can't see it very well. How does this thing work? All right? Please tell me you see a trend here. Can you see the bars? The forecast is the one you can't see. All right? The actual is a dark bar. They're terrible. These people have no idea what they're doing. Think about this. These people are paid to do one thing and one thing only, is to nail this. And they couldn't be more wrong. Look, here's 2008. Forecast was up about, 9%, 7%, somewhere in that range? Down. I mean, I don't know if there's a year. Okay, in 2003, it looks like they got somewhat close. 1 out of 18. What's going on here? If they can't do it, who can? The problem is, a year is nothing more than the time it takes for the Earth to go around a huge ball of gas. And markets don't run on calendars. They run on events, meaning things have to happen for markets to react. What happened, what ran the market, or what caused the market to move in 2019, it's not like in 2020 somebody hits a magical reset button of the NYSE and somehow what's going to drive the market is going to be different next year than this year. All right, what drives markets in the short term versus what drives markets in the long run, we got to talk about those because they're two very different things. And no matter how much money those investment banks pay those people, it's not enough to buy a crystal ball. And this is the reason why I'm not too concerned about what's going to happen next year in the market, because I don't know what's going to happen in the short term, because these people don't either. And if they don't know, no offense, nobody in this room knows, because it's impossible. So I'm not ripping on some of these very smart people. What I'm saying is take these forecasts with a grain of salt, okay? This is the time of year where we're going to start seeing these forecasts hitting us left and right and all over. I mean, every single forecast is going to start coming out soon. They're interesting. Read them if you like, but don't take them as gospel because they're going to be wrong. Do we have any small business owners in here, or former treasurers, or bookkeepers, anything like that? So if you run a business, typically what you do at the beginning of the year is you do a forecast, right? You say, okay, I wonder what my revenues are going to look like next year, and I want to figure out how much I'm going to spend. That allows you to forecast. Now, if you've ever done forecasting before, you'll know that they are always wrong. Every year, guaranteed, there's no way you know for sure how much money you're going to make. But you do it anyway, right? Because it forces you to think about things a little bit. So there's nothing wrong with forecasting, but just be very careful about what you're going to read on the news and see on TV, because all of it is either going to be lucky or wrong. There's no third option. Because, wait, wow, too fast. All right. This, like I said, this time of year is what I call Pundit Paradise. These people that go on TV and they give you their forecasts, okay? Oh, the market's going to be up, down. Stocks are cheap, they're expensive. Here's a really boring chart over here. I got another boring chart here. It's just this stuff that goes on and on and on. All right? Like I said earlier, it's a year. The market has no idea that it's January or December or anything like that. Markets run on events. So we're going to spend a lot of time talking today about those events. So this is not going to be your typical State of the Union market update where I showed you a bunch of economic charts, and hopefully you'll digest it all. It's going to be quite different. First thing we're going to do is we're going to learn. Nobody can hear me talk about markets until you get my primer on volatility. We have to understand what volatility is, why the short-term movements of markets happen, and what they really represent. From there, that will allow us to build a framework to assess what's going on in the economy. We have to figure out what's driving the market, and from there, where those drivers are going to be going. From there, we're going to do what I call a cleanse. All right, all this fear and panic out there, all this stuff on the news, trade wars, government debt. Oh yeah, we got this election next year too, if you haven't been noticing. Like all this craziness going on right now. We have to cleanse it, all right? Take it out of our minds, because it's going to cause us like this fog, which I learned today called an inversion here. Yeah, it's really weird. I never knew about that. But anyway, and then finally, we're going to discuss some of the key themes going forward. Key themes, investment themes, and risks. All right, I put them together because they're kind of, in many ways, they're often the same thing, unless you're careful. So let's talk about my volatility primer first. Simple question to everybody in the room. It's rhetorical. Don't answer it. When was the last time you made an emotionally fueled decision that resulted in a favorable outcome? I'm not talking about investing. I'm talking about in life. Think about it. That time where you got so mad, so angry, or so scared, you made a decision, and then a day later you thought back and like, man, I crushed that. I really nailed that. I'm so happy that I just overreacted or whatever it may be. It doesn't happen like that, right? Emotions get the best of us. So we got to talk about them and see how they actually cause our investment decisions to go haywire occasionally. So there's an awesome website on Google. It's called Trends. It's trends.google.com. All right? So if you go to trends.google.com, you type in a search phrase, what Google will tell you is how popular that search phrase has been on the internet over however time period you want to look at, right? So I did a Google Trend search on the word Brexit. Are we familiar with Brexit? All right, what happened in the UK in June of 2016 when they voted to leave the European Union? So, a lot of interest, as you could see, right around that time frame on Brexit, and then it disappeared very quickly because we all have ADD. All right? So, This is not a coincidence. I compared it to the S&P 500 during that time frame, and you can see it's pretty much a mirror image. This doesn't make any sense. Think about it. All right, let's do Verizon, okay? We're familiar with Verizon Wireless, right? They have cell phone company, right? So Verizon was down about 3.5% during this dip. The market was down closer to 5%. So Verizon, let's say they're down 3%, all right? Now we're talking about a company that sells a product that, in my personal opinion, people would rather turn off their water before they lost cell phone coverage, all right? I keep my cell phone like right here next to my heart for a reason. I love this thing, all right? This is one of the most consistent cash flow stories on the planet. People pay their cell phone bills. So, having said that, why would, oh, and by the way, they don't do any business in the UK. All of their business is done here in the United States. So, why would Verizon stock go down 3% if their fundamentals of their business were completely unharmed by Brexit, and furthermore, rebound within a matter of days? It doesn't make any sense. So what we have to do here is we have to break down these returns, or break down how a stock price works, or really any asset price works, to understand what the heck is going on here. Because I think we all can agree that Verizon's earnings did not go down 3% in 2 days because of Brexit. All right? Now, I'm sorry, we have to do one tiny little formula in here. This is the only math we're going to do. I promise, the only math we're going to do today, but we got to do it. So, when it comes to figuring out a stock price or any price, what we typically say is it's equal to some metric times the valuation, meaning how we value that metric. So, in the example of a stock, it's equal to typically earnings. That's one of the things that we value. It's not always, but we're going to use earnings in this example, times what's called a price to earnings ratio. All right? Now, if you're not familiar with a PE ratios, don't worry about it. We're not going to spend a lot of time on that. But an example kind of clears it up a little bit. So if you have a $90 stock price and you know that company just earned $5 last year in earnings per share, then you back into a multiple of 18. How do we get there? We just divide 90 by $5. Okay? Now, you can pull this up on Yahoo Finance, the stock price anytime, or on your phones or whatever it may be. You can also pull earnings per share. That's readily available information. Now, earnings don't change all that much. The stock price moves all over the place. Why? Because this thing changes every second of every day for most stocks. The valuation moves up and down. That's what's causing the gyrations in stock prices, not the earnings, okay? Companies, you don't see companies of the size of, like, say, Apple or Verizon. Their cash flow is not going to change that frequently, all right? At least not daily. So what I'm getting at here is these two components of price. We got to focus on these two components because this explains why I have no idea what's going to happen in the market next year and why I don't care. First, the metric, what I call fundamentals. What drives this stock price on fundamentals are earnings, revenue, cash flow. All right, numbers that I, as an analyst, can look at and say, I've got a pretty good idea how this is going to look over the next year or two, or whatever it may be. Because again, fundamentals of companies don't change all that often. Apple's not going to grow by 20% one year and shrink by 10% the next year. It's not that variable. It's very kind of consistent along the way. All right, and the price impact, like I said, I'm sorry, excuse me, I'll take a step back. So these are the fundamentals. All right. Fundamentals drive stock prices, but over here, emotions drive the other component, the valuation. How we value something, how we view that, that's the emotional component of the market. That changes all the time. So when Verizon's stock price went down 3 or 4%, the earnings didn't change. They couldn't have. All right? They don't have any customers over there. What changed was the emotional component of that stock price. And here's the thing about emotions. They're completely unpredictable. Think about it. Fear, panic, greed, euphoria. I'm going to regret saying this because it's being recorded. Stupidity. All right? All these things cause stock prices to go up and down all over the place. And here's the thing. These emotions are a lot like my 3-year-old right now I got at home. All right? This kid has got, in my opinion, the greatest life of any toddler on the planet. All right? She lives in California right now. It's sunny every day, right? And for no reason, she'll go in a stage 9 meltdown because her bacon's not cooked, as much as the other daughters. She goes crazy, like completely unpredictable meltdowns, Why? I don't know why, but I never see them coming. All right? And that's what's happening here. When we see the markets go up and down on a short-term basis, day to day, week to week, month to month, or even almost year to year almost, you're seeing the emotional component of the market go up and down. It's completely unpredictable. And if people say they know what's happening, they're not. They're lying. You can't consistently get this right. And here's the thing about emotions. They never last. Emotions don't derail $20 trillion economies. It doesn't work like that. So when I say that I don't know what's going to happen in the market and I don't care, it's because I know whatever is moving the market on a day-to-day basis is going to go away at some point. I focus on the fundamentals because I can analyze them, I can have a pretty good idea where they're going, and I know over the long run they're going to move that stock price either higher or lower, or whatever asset price we're talking about. So follow my logic here, okay? Volatility, right? When we say the word volatility, it means it measures the short-term movements in markets, right? The ups and downs, you said earlier, this kind of reaction, right? Well, short-term movements in markets, we just said, are fueled by emotions, right? Does that make sense? So by association, volatility is nothing more than a measure of emotion. So when people on TV are saying, well, markets are really volatile right now, what are they really saying? They're saying markets are really emotional right now. And markets, stocks, asset prices, economies don't derail because of emotions, especially ones our size. It doesn't work like that. So one of the biggest misconceptions out there is volatility and risk are the same thing. They aren't. When I see short-term volatility, I know that the odds of that causing long-term risk are almost infinitesimally small. And that's the reason why I don't panic. That's the reason why I don't worry. Because ironically, volatility creates opportunity. Does anybody remember the fourth quarter of last year? Does anybody remember Christmas Eve of last year? Yeah, that was a fun one, down 5% or whatever it was in a day. Yeah, that night I was actually talking with some coworkers. Yes, Christmas Eve night, by the way, wildly popular with my wife. We had our entire family in town with a baby. But look, opportunities like this don't come along very often. We had to take advantage of them, so I ended up working that night. My point here is that inspired me to go out and try to figure out, okay, fourth quarter of last year was a bad quarter. We were down like 17, 18% at one point. That doesn't happen very often. So what I wanted to do is I wanted to find some data out there to figure out how markets react in the worst of worst quarters, okay? So I found a table that showed me, here's the worst quarterly performance over the since 1940, okay? These are bad quarters. The average being down 20%. In 3 months, that's ugly. But don't think about it. Look at the 1 year, 3 year, and 5 year returns after the worst quarters we've seen in the last almost 80 years. Up 23%, up 50, up 100. That's awesome. But does that make any sense? Think about look how consistent this is. Every single quarter that was so horrific and ugly and caused so much panic, you see a massive rebound. It's consistent. What's happening? This guy's out there waiting for you. And me. And every other professional investor waiting for the retail investors, the individual investors out there watching TV, watching Kramer lose his mind on television, or whatever his Markets in Turmoil, that CNBC show. And they just can't take the pain. They lose too much sleep. They get up in the morning. They call their financial advisor, say, "I can't take the pain anymore. Get me out." And guess what happens? I and this dude over here are on the other side of the trade saying, "I understand. I'm here to help. I will buy that stock, offer you 20% off. No problem. Here's some cash." The professional investors wait for retail to panic, and they jump in and they take advantage of you. That's why this happens so consistently. So just keep that in mind the next time that panic starts to set in, all right? Because nobody in here is going to do that, all right? You're going to call Sean and his team, and they're going to talk you off the ledge, all right? Markets may move crazy, but economies don't. All right, our economy is 20-something trillion right now. If it's turning, it's like an oil tanker, right? One of those huge oil tankers. Course corrections take a really long time, and if you know what to look for, you can actually kind of see it happening. When you see something moving like a speedboat, well, guess what? That's not being run by fundamentals, because fundamentals of our economy and the companies that work within it do not move that fast. The only thing that moves that fast are emotions, and emotions get forgotten very quickly. But they do create opportunity, which is the reason why I watch the market on a day-to-day basis. Stocks go on sale every day. All right, you don't always get it, but every once in a while you do. So 3 key points I want you to remember about volatility before we move on. First, it is temporary. Emotions rule the short-term movements in markets. They are unpredictable. If you want to time markets, here's my recommendation. Get in a car, drive down to Vegas, okay? Because the casinos down there still give away free drinks. I've spent a lot of time at the NYSE. There's no bar there. All right, you might as well get drunk if you're gambling. If you're going to sit there and try to time markets, you will lose. It's the only guarantee I can give you right now. It is impossible to time markets over the long run. It just is. And furthermore, the reason why I don't try, aside from I don't have a crystal ball, is that the math doesn't support it. If you look at the attribution of long-term returns, meaning what drives long-term returns for investors, 93% of your long-term return will be attributed to what's called asset allocation. What are the 3 most important rules in real estate? We know them all, right? Location, 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 right? It's the same thing in investing. Picking the right geographies and the right sectors within those geographies and asset classes will determine 93% of your long-term returns. Stock picking, what they call security selection, 4.5%. Stock picking can work, but it's just a lot of work. A lot of work. The best stock picker I know, he makes millions of dollars a year in New York, is a buddy of mine. The best I know. He, at any given time, probably has 5 or 6 stocks on his radar. Because he's like, I can't handle the work of having any more in my portfolio. Okay? That's a lot of work for, as you can see, a little bit of return over time. Market timing, if you get it right, it's going to add about 2% to your long-term return. It's not worth it. So I don't mess around with it. So, third thing, it is very opportunistic. I love volatility because when I see panic in the water, it's a huge opportunity. It really is. And it's so consistent, too. It's one of the few things in this world, particularly in investing, that's consistent. So, having said that, let's go on to what I call economic analysis. Like I said, I want to make sure everybody has a framework here. You don't need a PhD from Stanford to understand how to analyze the economy. I use 6 variables. So I had somebody come into my office about 6 months ago, and they were trying to sell me on they had a macro fund, and they said they had 113 economic factors that they put into this little fancy little model they put together. And I looked at this guy straight in the face. My wife tells me I need to work on my poker face. And I just started laughing. I'm like, 113 variables? Are you nuts? I mean, like, I don't even know 130. I don't know 30 economic variables off the top of my head. I use 6. Only 6. All right, so we're going to talk about that. When I was in high school, I played basketball, and my basketball coach in high school really only taught me one thing that still to this day that I've used. He was an old Navy guy. Back in the 1960s, the Navy came out with a design principle called KISS. Have you ever heard of this before? Keep it simple, stupid. All right, that's the only thing I learned from my coach, is that when you keep things simple in your life, you tend to produce better outcomes. So I approach economic and most of my analysis actually with what I like to think is a very simplistic approach. I'll explain to you how that works here. Again, a little funky on the colors. I apologize. If I want to figure out where the economy is headed, I have to ask myself, what drives the economy? All right? What causes the economy to move forward or backward or whatever it may be? And there are 4 key components to gross domestic product, right? GDP, measure of economic activity, trade, government, business spending, and consumer spending. Consumer spending is 70% of the U.S. economy, what we do on a day-to-day basis. If you buy Starbucks coffee, you go out to dinner, whatever it may be, that's driving our economy. It is absolutely critical to the U.S. economy for us to have our wallets out and spending money. Business spending is about a little bit under 20%. When you combine these two, about 87% of our economy is what we call consumption-driven. As long as we're all spending money, our economy is going to move forward. So I have to ask myself 2 questions then. can we spend? Do we have the ability to spend money? And if so, do we want to spend it? Again, we're keeping this simple question. Do I have money in my pocket? If I do, am I willing to give it up for something in return? Those are the only two questions we really need to ask. Now, within them, there's sub-questions. This is the can. This is the do we want to. So let's talk about these first. 3 questions I ask to determine if we can spend money. First, is money accessible? Right? The Fed controls access to our money for the most part, well, through the banks. Is money cheap and available? This is by far the most important of the 6 questions. Because if we don't have access to money, and if it's not cheap to borrow, our economy does not grow. When the Fed raises interest rates, what happens? All right, as interest rates rise, do we buy cars? Do we buy homes? We start to buy less of them, right? Because interest payments rise. The Fed controls our access to money. It is critically important that money is accessible to us, and it comes through the Fed and through the banks. This is the most important of them all. Why? Because the overwhelming majority of purchases in this country are done on credit. Again, if you want to buy a house, car, boat, whatever it is, fancy ski equipment here in Salt Lake, you almost always take a loan out to buy it. Can we afford our debts? All right, first rule of debt analysis is not the size of the debt that matters. It's the size of the interest payments. Can you afford the interest payments? So, because debt is such a big component to consumer spending, we have to ask ourselves, do we have the capacity for more debt as consumers and businesses for that matter too? All right, can we afford our debts? Third question, are we making money? All right, very simple. Do we have money coming in the door? Do we have a job? Are our wages rising over time? Questions like that, data like that. Are we confident? This is important. All right, just because you have money doesn't mean you're going to spend it, right? Do you feel good about yourself? Are you making money at work? Do you feel good about your future prospects? Are your bosses happy? Kind of a weird one. But the overwhelming majority of employment in this country is done through small businesses. All right, so typically businesses of fewer than, call it 50 employees, overwhelmingly dominate employment in this country. So I look for small business confidence surveys. All right, are CEOs happy? Are they feeling pretty good about their business? Are they going to be hiring more people? Things like that. And are financial assets rising? The majority of consumer spending is done by mass affluent and above, mass affluent to high net worth. So basically the wealthy people in this country spend the most money. Shouldn't be of any surprise. People that own stocks, bonds, and real estate tend to be wealthy consumers. So think about it. When your homes and your stock portfolios and your bond portfolios are doing well, you tend to feel a little bit better about your future prospects. You know, when you go out to dinner, maybe instead of spending $50 on a bottle of wine, you spend 60 or whatever it is you spend, right? My point is your purse strings loosen up a little bit. These are the 6 questions I ask on a regular basis. That's it. I don't look at some like second derivative of some ridiculously stupid economic variable that's probably wrong. All right? I look at these 6 questions. It doesn't require a PhD, and almost all this data is readily available on a Google search. So let's kind of compare the two. Think about the ability versus the willingness. Can we spend? That's the ability. Willingness, do we want to? All right? Think about the differences. This is what we call hard data. All right? Is the Fed giving money to us? What are interest rates? What are debt levels right now? This is physical, this is quantitative data that we can pull out. Whereas willingness is what I call soft data. The problem with the willingness data is like, for example, consumer confidence, right? That can change quite a bit. One day you feel pretty good about your life, the market's down 20% over 3 months, then you panic and think the world's ending. All right? So my point here is this is more qualitative data from surveys. It's less reliable. We have to be very careful with the willingness data. But my point here is that the drivers of ability are the fundamentals. All right? Fundamentals meaning debt service levels, interest rates, the Fed's liquidity, whatever it may be, to give us access to that money. Wage growth. Wage growth is a good example. Quantitative, hard number, doesn't change that frequently. All right? Whereas the willingness, it's all driven on emotions. Does this chart look relatively familiar to something we just looked at like maybe 5 minutes ago? Remember the drivers of a stock price? You have your fundamentals over here, and then you have the valuation over here. One was driven by fundamentals, one was very migratory, doesn't move very often, and the other one was very erratic. All right? Same thing here. Now, we have to pay attention to the willingness, but by far the most important of these are the ability. Because think about it this way. If you want to spend money, you don't have it, you're kind of out of luck, right? So that's kind of how this works. We focus a lot on the ability, but we also pay attention to the willingness because it does tend to drive some of the short-term movement. So add it all up and think about it this way. Small business owners start feeling pretty good about the future prospects. What happens? They start hiring more people. They start spending more money on property, plant, and equipment. They start hiring more people. What happens? The unemployment rate goes down. As the unemployment rate goes down, qualified workers get hired. That means there's a smaller supply of qualified workers available to go work. So what do? You start paying people more money, right? Because you're qualified workers, you don't want them to leave to your competitor. So you start paying them so they don't leave. What is that? That's wage gains. You start making more money, what happens? You start feeling a little bit better about yourself, right? A little bit more confidence. All right? You go to the movie theater, you get that large bucket of popcorn, whatever it may be. All right, you start spending more money, demand for goods rises. All right, what happens when demand for goods rise? We all start making more money and we say, you know what, I'm going to go buy that really awesome new Corvette that's coming out that's sold out for like 2 years already. All right, what do you think Corvette's going to do? Raise their price. What's that? That's inflation. When inflation happens in an economy, what happens? The Fed starts noticing, and they say, hey, wait a minute, everybody's happy, let's go ruin it for everyone. And they raise their interest rates. And that's how the economy works, in a nutshell. So we got to figure out where we are right now, and when is the Fed going to come in and ruin it for all? Because they will. That's what they do best. So disclaimer, I don't like the Fed very much. You're going to learn this quickly. I'm going to try not to lose my temper when I talk about them, but I can't make any promises. So the ability to spend, I think, is very high right now. There's never been this level of liquidity in our economy. If you want to take a loan out and you have decent credit, you can get it, and it is dirt cheap. We've never seen access to money like this ever in the history of our country. And that's a good thing. For now, it's a good thing. We'll get into the risks later. It's very affordable, like I just said, low interest rates. Debt levels, believe it or not, are actually not that bad right now. Now, I'm not talking about total size of the debt. I'm talking about, can we afford our debts? And right now, overall, we can afford our debts. Now, there are some instances where debt's a problem, obviously, some student loan issues and things like that here and there. But for the most part, people have the ability right now to take on more debt if they want it. And sustainability. Wage growth is pretty good right now. This matters because think about it this way. We want to see wage growth higher than inflation, right? Because inflation kills our purchasing power. It eats away at our net worth every year. So if wage gains are higher than inflation, that tells me that we're creating real wealth. Does that make sense? So right now, for the most part, wage growth is slightly above inflation. Now, the Fed will tell you inflation is right around 1.7%, okay? Whose medical bills are only going up 1.7% a year? Senior care, grocery bills? Yeah, I didn't think so. Inflation is a very specific idea for different types of consumers. What I call retiree inflation is way different than inflation for like a millennial. All right? So my point, but overall, it's okay. It's not great, it's okay. In a weird way, this is actually a good thing because if we start seeing wage gains way, way higher than inflation, what we're going to start seeing is inflation start rising, right? Because like I said earlier, and inflation starts rising, that's when the Fed's going to come in and say, hey, people are happy, let's ruin their lives, all right? Because that's what the Fed does. So overall, I think we're in a pretty good spot with the ability to spend. The willingness to spend, this is a little trickier. This moves quite frequently. If you asked me this question 6 months ago or even 4 months ago, I would have said, it's not so great. Right now, it's pretty good based on the data that we're seeing. Financial assets continue to rise. That's a good thing, all right? Because again, if our house prices keep rising and our stock portfolios keep going up, we feel better about ourselves. We'll spend more money. Confidence, again, we mentioned that, but also the outlook. Now, there are issues. There are always issues out there. But right now, for the most part, I think that we're not seeing any major concerns run to cash, any kind of activity that will lead us to believe that consumers have any reason to stop spending money just yet. This could change. It could change very quickly. But for the most part, we're in a pretty good spot. So I think going forward, if I had to rate the economy, I'd say it's kind of like a strong B+. I don't really know for sure, but I think that's kind of where we are. It's very resilient right now. I think the risk of a recession next year or even maybe for the next 18 months is extremely low. It could change, but what would cause a recession? We just talked about this. Consumers would have to stop spending money. All right? The manufacturing data that we're seeing out there and all this scares about trade wars and all this other garbage, none of that matters. The question you have to ask yourself is, what is going to get consumers to stop spending money? And I can't think of anything. Stuff like this doesn't turn on a dime either. That being said, I think it is slowing. I think we could see consumer spending. I could see economic activity slowing going forward. Not a bad thing. I'll take slow and steady growth any day over hyperbolic growth, because hyperbolic growth turns into bubbles. All right? I love slow and steady growth, which is what we've had for several years now. I could see it slowing down, though, a little bit. Just because it was on fire so much over the last, call it, year or two. So I think from an economic standpoint, we're in a pretty good spot. Okay. All right, so addressing fear. What I say, climbing the wall of worry. All these fears out there. I could spend 2 hours just talking about all of them, right? You got trade wars. That's a big one. We've got a presidential election coming up. The yield curve inverted. Not a more boring subject to talk about, by the way. If you want to talk about the yield curve, I will afterwards, but it's too late in the night to get into the yield curve. U.S. debt situation. I'm sure everybody's really happy about the government debt situation we're dealing with in our country. All right, that causes some concern. Geopolitical. There's a lot of wackos out there that have their fingers on bombs, right? So there's always something out there to worry about. There are two that I want to spend a little bit of time on. Not surprising, trade wars is a big one, okay? This is something that just keeps popping up over and over and over again. I found this awesome chart online. I stole it. I did source it, but I stole it. This trade war cycle where, the administration gets tough, market sells off on trade war fears. We saw that back, a couple months ago, back in August or so. And then they hit a resolution, which happened about a month ago. And then, the market rallies, and then, nothing happens. And we've been doing this for like a year now, right? Nonstop. It's just going to keep going and going and going. What's going to happen with trade wars? Here's my theory on this. It is a theory. I obviously don't have a crystal ball. The short version is trade wars are not a problem. This trade war we're entering with China is not going to push the U.S. into a recession. It doesn't work like that. Manufacturing here in the U.S. represents around 11% of our economy. About 1% of our GDP goes over to China every year in terms of exports. All right? China sends over about 8% of their exports to us, which means we've got purchasing power over them. We're bully. We're Walmart, and they're the distributor to Walmart. Okay? So my point here is that we can kind of push them around to a pretty large degree, and there's not much they can really do about it. I don't think this is going to get resolved anytime soon. I wish I had better news for everyone, but in my opinion, this could go on for many, many years. Here's why. China is a unique communist society. They're the second largest economy in the world, and they are a very wealthy nation relative to the rest of the world. They can sit this one out for a while. They can provide stimulus to their economy. They have no incentive whatsoever to bow down to the U.S. There are politics, there are huge egos involved, and these politicians may as well just say, think about it from their perspective. They could say, all right, look, if Trump loses in November next year, then we may get out of this whole situation if we just wait it out. And even if Trump does win, it's only 5 years away. 5 years in the world of politics between the two largest countries in the entire world is not that much time. I don't think that they're going to really bow down. China has never once budged on their trade policy. They've been stealing intellectual property from not just us, but the rest of the world for 3 decades almost now. Why would they change it now? Okay? That's their position. Now, I'm not saying they're right or wrong. I'm just saying I think from China's mindset, they're looking at this as saying, well, we have no incentive to really change. We can ride this storm out. I don't think it's going to change here in the U.S. So China's not going to change their position. I don't think the U.S. is going to change their position either, okay? Because if Trump does lose next year and a Democrat comes in, I don't think the Democrats are going to change either. They are not very public about this, but there is a lot of support of the Democrats for fighting China. Like I said, no Democrat's going to come out and support Trump on anything right now. But quietly, if you talk to on the Hill, there is a lot of support for being tough on China because it's like a now or never thing. We're the biggest economy in the world. 10 years from now, China more than likely will surpass us, or there's a high probability they will. Once they get that big, we might not have a second chance of changing the game. So my point here is that I think this is going to stay in the news for a while. The cycle you're seeing here is probably going to keep going on and on and on, and we're just going to have to deal with it. But it is not going to impact our economy. Not materially. Yeah, some sectors will get hit, no question about it. But overall, these tariffs are not going to change consumer spending all that much in aggregate. Presidential elections. Okay, let's just get through this, all right? My disclaimer up front, I despise both parties equally, but for very different reasons. I'm here to talk investments and strategy. If I say something you like, don't throw anything at me, all right? I'm not here to tell you my political views and my political opinions. The absolute most dangerous thing any investor can do is get political about their investments. You check those at the door there, all right? You got to ask yourself going forward in investing, how is this going to make me money or how is this going to lose me money? It's that simple. Do not get emotional about this stuff. Okay, that being said, there's a huge difference between politics and policy. Huge difference. Those two words mean something completely different, all right? So I tried to break them down on a nice pretty chart that's going to look like two other charts we saw earlier. All right, politics, what I say in terms of substance, is very vapid. You could say whatever you want, whenever you want. I could tell you exactly what Salt Lake City wants to hear tonight, go back home to the Bay Area tomorrow and say something completely different. I can lie. There's no accountability. I can do whatever I want. Why? What am I trying to do from a political standpoint? It's to win votes. That's pretty short term, right? All right. What drives politics? Emotions, right? All of that. Now think about policy for a second. Very different. Policy is vetted. Commitments are very firm. Once you get policy enacted, it is very, very hard to unwind. Why? Because it's a lot of accountability. There's a lot of checks and balances. One of the reasons why our government moves so slowly is because of those checks and balances. So this is certainly more long-term, more fundamentally driven, okay? This is designed to enact change. Again, same theme as we've seen tonight, fundamentals, emotions. This stuff doesn't last, all right? Anything that's emotionally driven doesn't last. I got asked, I went on, so this is a long story, I'll keep it short. In February of 2016, I went on Bloomberg TV, okay? And I wasn't even there to talk politics, but they started talking about, this is right around the time that Trump was about to win the Republican Party, what they thought he was, the Republican ticket. And I just mentioned before commercial break, it's like, well, I think Trump's going to beat Hillary. So Bloomberg is slightly liberal in terms of their news coverage. And the host just attacked me. And I was like, well, hold on, I'm not coming on as a Republican. I'm just saying, like, I think he's going to win. So I went through this whole thing. And they just attacked me. So the day after the election, the day after Trump won, I got a call from Bloomberg TV. They said, hey, you're one of the few people that went on our network and actually thought he was going to. I was like, I didn't predict it. They're like, well, can you come back on TV? I couldn't do it that day. I went like 2 days later, something like that. And they asked me, well, Mike, you called in. What did you do when you found out Trump won? Like, what did you do to your portfolios? What changes did you make? What do you think the first one or two things I would have done to a portfolio after that surprise election? No snide comments out here, all right? I heard it, nothing. I told her, I did nothing. Nothing changed. Politics don't change anything. I was like, we don't know what he's going to do. And I was like, look, think about Obamacare for a second, okay? This is the best example I can think of. Now, whether you like Obamacare, doesn't matter. Point is that in 2008, Barack Obama was in the White House. The Democrats owned Congress, and it still took 6.5 years to get that first policy in front of Americans. This stuff moves so slow, all right? So whatever happens in November of next year, don't let it affect your portfolio. Now, sure, policy matters, okay? It does, but it takes so long for this stuff to happen. So don't make any rash move. If your candidate loses, okay. So be it. When Obama got reelected in 2012, the market went down 6% in 2 days. Guess what happened after that? It ripped. all right? It's Republican, Democrat, none of that stuff matters, all right? It matters for your personal, your ideals and all that, that's fine. Keep all of that out of your portfolio. So whatever we see next year, just let it slide. So, all right, that was good. I didn't nobody yelled at me. That's good. All right. I wrote about this a couple weeks ago. Don't get mad. What I call market attention deficit disorder. It's this thing. I saw this a couple years ago with investors. So I married a Greek woman and is married into this huge Greek family. Okay, so that movie, The Big Fat Greek Wedding, a couple years ago. So that was like a documentary for me. I lived that wedding. I'm not kidding. Everybody's like loud in your face and going crazy. So right around the time of the Greek debt crisis was in July of 2015, right around the time I got married. And her entire family, no matter what was going on, they were calling me, emailing me, what's going on with Greece, this and that. The country was effectively failing. Greece, which is a country that represents 0.78% of world GDP at the time, caused the US stock market to go down like 8%. That makes no sense. So I was baffled by this. Like, how could this matter? We don't rely on Greece for anything except for like olives. And we're watching the US stock market getting hammered. So they did what they do best. They kicked the can down the road. The IMF came in and bailed them out. They said, let's worry about this in a couple of years. So the market recovered after the Greek debt crisis went away. And over the next 2-3 years, the situation in Greece got materially worse. 5% of their workforce left the country. That's like New York and LA leaving the US. It's a big deal in terms of job creators and whatnot. Their economy went into a depression. And as it got worse, what do you think it did to the stock market here in the US? Nothing. That makes no sense. You're talking me a crisis that caused our market to go to 8% now doesn't matter? Why? Because it wasn't page 1. It was barely page 9. It may have gotten mentioned before commercial every once in a while on CNBC, but for the most part, it was a non-event. It's what I call mad. It was really interesting for a while, caused the market to move a little bit, but then investors got bored. Why? Because the networks are saying, this is old news, let's move on to something else. And since they're watching CNBC and all these other networks, they get fixated on the other story that's moving the market, and they bounce around. Oh, it's Trump tweeting, it's China, it's Brexit, it's yield curve, politics, terrorism, negative interest rates. All these things are causing people to go crazy. Don't get mad. How do you do that? Stop watching financial news networks. It ends right now, unless I'm on. If I'm on, you could do it, but because I'm not going to mess with your head. But for the most part, these networks are poison. They really are. You can't take this stuff seriously. They're just making up stories. If you knew what I knew about how these networks work, you'd be sick. All right? They are not going to help you with the fundamentals. They're going to help you with your emotions. It cannot get mad. So, that being said, let's go to the final section. What I say, don't bring a knife to a gunfight. All right. Let's talk about some investment themes and some risks. Now, typical presentation, you talk about where we see opportunity, and then another section, here's a couple risks here and there. I put them together. Why? Because it's kind of the same thing. A lot of times, what may appear to be a risk, if you look at it through the right lens, could be a phenomenal opportunity. All this stuff is merged together. So we're going to have to talk about it as one. So I'm going to spend some time talking about asset allocation. I'm going to not sugarcoat the fact that it's getting a lot harder out there right now, so we need to talk about some of the complexity in markets. And then also, what does that say? I don't even remember. Oh, innovation. Some of the kind of the long-term investment themes that we're seeing that we want to make sure that we have some exposure to, because they really are going to change the world over the next couple of years. So I've got 5 fun facts for everybody in the room today here. We are currently in the 127th month of the economic expansion. We're in the 130th month of this equity bull market. Both the longest ever. That's awesome, by the way. All right? We have the lowest peacetime unemployment rate in 70 years. Best 9 months start to a year since 1998 in the S&P 500. Obviously through September 30th of this year. And the Fed lowered interest rates 3 times this year. Of these 5 facts, which one doesn't belong? Does that make an ounce of sense? The Fed shouldn't lower interest rates unless they're worried the economy is falling into recession, right? We talked about that. If the Fed lowers interest rates, that makes money cheaper. So we can take out loans, spend more money, causes our economy to go up, okay? Why? And what possible reason could the Fed have to lower interest rates 3 times this year? We're in a really, really weird situation right now. Now, is there risk? I don't think so, not in the short term. And when I'm saying short term, the next couple of years. Longer term, we may have some issues that we're going to have to discuss today. But for the most part, this is a really strange situation we're in. I think we're kind of entering the early stages of the late cycle of the economy. I mentioned earlier, economies are cyclical. Oh, I have a chart, I have a table here. This is awesome. I usually don't have one of these. All right, economies are cyclical, right? So, I think we're probably kind of somewhere around here. Give or take. I don't know for sure. Somewhere around there. The challenge about this late cycle is that it doesn't look like most late cycles we've seen in past cycles, okay? Like, here's going into the financial crisis, going into 2000, right? Things like that. This kind of area here. If you look at your typical, what I call textbook late cycle event, GDP's moderating, all right, right now. Yeah, it's moderating. It's kind of slowing down a little bit, but we're not quite sure how long or how much it's going to moderate. But it's a very, very mild moderation. Inflation tends to be rising at this point. We mentioned this earlier. People are spending more money. Demand for goods goes up. Inflation rises. We're not seeing that right now. Now, we are seeing inflation in certain parts of the economy, no question. But overall, we're not seeing a ton of it. Fed policy is typically hawkish. That's a fancy financial term for raising interest rates. When the Fed is hawkish, that means they are trying to attack inflation by raising interest rates. That's typically what we start seeing in late cycle. They are dovish right now, meaning they're cutting interest rates. For some reason, they're worried our economy's at risk, or they were at least. The time frame for your typical late cycle is around 1.5 years. Now, I said this at the very beginning. Markets don't run on calendars. This is just a historical average. This could go on for a very, very long time, years. We don't know yet. Bonds tend to do worse. Stocks tend to be in line with cash in your textbook late cycle environment. Right now, they're both doing better than cash. Well, pretty much anything's doing better than cash. All right? So my point here is that this is a very quirky kind of late cycle event. Why would we, you're probably thinking, well, wait a minute, this doesn't look anything like late cycle, then why are we in late cycle? Valid question. The reason why I think that is because of the employment situation right now. I don't know how much it can get, I don't know how much it can get much better. I mean, we have really good employment in our country. Yes, it could get a little bit better. Yes, we have some people that are out of work that may re-enter the workforce at some point. But for most part, if you want a job and you're qualified, you can find it. And it's hard to get much better at that point. So that's the reason why I think we are really kind of the early stages of the late cycle. But we have to talk about some of the things that we're going to have to face going forward. Because like I said, I'm not going to sugarcoat it. It's getting a lot harder to do this job. What I call the days of easy retirement, those are over. They are never coming back. I'm sorry, that's just the way it is. Now, that's not a bad thing. We just have to recognize that what worked in the past is not going to work going forward. It's this whole idea of bringing a knife to a gunfight. The best example I can use is a car, right? This is near term in my memory. So I just moved from New York City, where I lived there for like 12 years, to California, right? So I just had to buy this car. So it made me think about like when I was a kid, back in the 70s and 80s, when our family car broke down, what would happen? My dad, who's the cheapest man alive, would never go to a mechanic for any reason whatsoever. He'd go out to the garage, get a wrench, and I don't know, he'd bang the car with a wrench. I don't know what he did. I don't know anything about cars. But he would like change the spark plugs or whatever, right? Because back in the day, you could work on your own car, all right? Today, this car I bought has a touch screen in it. You're not going to fix that. I mean, maybe unless you have like a computer science degree, you might be able to change the air in the tires of some of these cars. But for the most part, cars today they're unbelievable. They're incredibly complex. I mean, is that a bad thing? I don't think so. I mean, they have, they're faster. They have better brakes, better fuel efficiency. Some of these cars park themselves, which I still can't believe. All right, you just can't fix them yourself anymore. That's where we are in financial markets today. The complexity in financial markets is off the charts. You can't do it yourself anymore. And that's not a sales pitch. That's the reality of the world we live in. 60-40, a couple treasury bonds and money market funds and collecting income, paying your bills, that's done. And I don't see that coming back in anytime soon. All right? So we have to use different strategies, not, buy gold and, condensed milk and guns and live in your tent somewhere. I'm just saying shift the strategy. So that's what we're going to talk about, is the kind of shift that we have to deal with, because we've got a lot of things that we're facing right now. Does anybody speak Latin, or not speak Latin? Does anybody read Latin in here? You don't speak Latin, if I remember correctly. I don't read it either. I had to Google this, all right? So basically, when you translate this, which I'm not even going to try to pronounce, it says, I fear the Greeks even when they bring gifts. Not my relatives. I mean, this is that whole story, the Trojan horse, the wooden Trojan horse that got pushed behind the gates, right? And then they thought they got a gift, and then all the soldiers came out and murdered everyone. So my point with this analogy is, this is how I feel about the Fed, is that I want to feel like they're on our side, but I just don't trust them. I don't, because they always screw up. All right? So the Fed is unbelievable. I don't know why they cut interest rates this year. Now, I don't think they're going to cause any problems, but we have to pay attention to what they're doing, because there may be long-term ramifications for the policy decisions that they are making. Now, the good news is that I think the last thing the Fed wants is for our economy to slow down an inch. In fact, they have zero incentive whatsoever to raise interest rates too far, too fast, because in their minds, inflation is about 1.7%. The Fed starts paying attention to inflation at right around 2%. Once it hits around 2.5%, they start aggressively raising interest rates, because they don't want inflation to get out of control like it did in the 70s. That's their goal. So right now, they're saying, I don't have much incentive to raise interest rates too far, too fast, because there's no inflation and employment's pretty good. That's a good thing. I also think that they don't want the party to end anytime soon, because I think that they are very well aware that the overwhelming majority of this country did not participate in the first 7 or 8 years of that economic recovery. Right? Those that own stocks and bonds recovered, or those that own their homes, but there's a large percentage of this country that just didn't do well. We talk about this income gap, and I think they're very well aware that they caused that. So over the past 2 years or so, we're starting to see more people in this country, pretty much almost every demographic, is starting to do much better than they were before. And if they come in and they end the party right now, they're going to crush a large portion of this country. I can't prove this, but it seems to me like they're very well aware that they can't end the party just yet. Now, they are using policy decisions. The example that I like to use, they're using these bond buying programs called quantitative easing and all the little tools that they're using. These are extreme measures being used for very small circumstances. They're dropping atomic bombs on anthills right now. And the problem is, if you do that too often, atomic bombs start losing their power. Another example is, okay, let's say you got a headache, you take an Advil, right? Then you start taking 2 Advil every day because you want to prevent headaches from happening. What's going to happen? Over time, you're going to need to take more and more Advil to get the same effect, right? And at some point, your body's just not going to it's not going to feel that effect anymore. The policy decisions they're doing right now are meant for extreme measures. Like quantitative easing, up until 2008, hadn't happened since the Great Depression. All right? You don't mess around with this stuff too often. And what we're seeing in other economies is crazy. We'll talk about that in just a second. So my concern right now is not near term. Near term, I think the Fed is on our side, and they're going to make sure the markets continue to go up as much as they can. Long term, at some point, what scares me is a world where central banks cannot pull an economy out of recession. And if they keep screwing around the way they are right now, 15 years from now, 20 years from now, I don't know if their policy tools are going to be as effective anymore. That's a concern I have. But that's down the road. Right now, the Fed is on our side. That's a good thing. Let's talk about negative interest rates. This is crazy. Think about what I just said. Negative interest rate. That's insane. All right? Let's say I borrow $100,000, all right? I borrow $100,000 from you, all right? 3 years later, I promise to give you $130,000 back, all right? You get compensated 30 grand for taking on the risk of giving money to a complete stranger that's two small kids that might take your money because he needs money, right? So that's the risk that you run. You get compensated for it. A negative interest rate is you give me 100 grand and 3 years later, I give you $990,000 back. That's what a negative interest rate is. That makes 0 sense in finance, all right? But they become so pervasive. Here's some fun facts. Germany recently issued a 30-year bond with a negative interest rate. Imagine that. Buying a bond today, 30 years from now, you're going to get less money when the principal's returned to you. All right? In Austria, they have a 100-year bond that's trading with a negative interest rate right now. Think about that. That's insane. 44% of bonds outside of the U.S. right now have negative yields on them. Some junk bonds in Europe trade with negative yields. Let that marinate for a second in your brain. When something has a junk bond yield on it, that means it's a risky investment. You might not get paid back. And yet you're still getting a negative interest rate on it. It's insane. And my favorite one of all, a bank in Denmark is now offering a negative interest rate mortgage. Yeah, I don't know what's going on. If you ask a lot of people about negative interest rates, they say, oh, it's no big deal. You know, it's just the gradual progression. It doesn't mean anything. I don't agree with that. I don't think the world is ending, but truthfully, I don't know how this ends. And as a result, I'm very cautious about allocating money right now to any economy where negative interest rates are pervasive, because it becomes really difficult to use your typical modern financial tools with negative interest rates. It's hard to value things. It's hard to price risk. All of that gets thrown out the window. So I really don't understand how a lot of this ends. What I do know is I don't like it. So I don't think negative interest rates are going to make it to the U.S., at least anytime soon, but I don't know. It's hard to say. What I do know is that if you look in other areas of fixed income, this is going to be a hard chart to see. One other area of concern that I do have, though, here in the U.S., and I've been talking a lot about it, is the fixed income market. Now, has anybody noticed what the Barclays... So the Barclays Ag Index is like the S&P 500 for the bond market, okay? It's kind of that, what everybody looks at to see how the bond market is performing. And it has ripped this year. It is up, I don't remember what it's up right now. At one point it was up, I think, 8% through, 8% through the end of September. Bonds don't deliver 8% in 9 months. It's not supposed to work like that. In fact, I can prove it. Here's a chart from 2001 to 2018, the attribution of returns, price versus coupon. Now think about what a bond is. It's a loan. It's a loan, right? So you give me 100 grand, I give you 130,000 back. Your profit is the 30,000, all right? You get your principal back. That 30,000 is the coupon, the interest payment, okay? Now, in a normal fixed income environment, almost all of your return should come from the interest payments. Does that make sense? Where else would it come from? All right? And it's also a finite instrument, okay? A loan has a date where I got to get the money back, all right? Whereas a stock could go on forever, and a stock could trade forever. But these are finite instruments. If you give me $100,000 in principal, I'm not going to give you $110,000 in principal back. I'm going to give you $100,000 and whatever interest I owe you. So, this makes sense. I know it's hard to see, but the coupon, the yield, in most major bond markets across the world, the yield drives the overwhelming majority of returns in bonds. I like a chart like this because it's predictable. This is this year, the first 3 quarters of the year, first 9 months, January through September 2019. Here, the price has been the overwhelming driver of returns. That is really, really weird. Now, bonds can trade, so that you can trade, let's say you loan me $100,000. You don't want that loan anymore. You could sell that loan to somebody else, and they might pay you a little bit more than $100,000 to acquire it because the interest rate may be more attractive, something like that. So bond prices do move up and down, all right? But here's the thing. Bonds mature at par. Like I said, I'm not giving you 110 at maturity. I'm giving you 100. Bonds mature at par. So if something is trading at 110 right now, if a bond's trading at 110, it is guaranteed that that bond is going to go back at maturity at 100 or less. It can't go at 110. So meaning the returns that we've seen this year, these stratospheric returns in the bond market, are going to have to get paid back at some point. Meaning the bond market's probably going to get hit at some point pretty bad. All right? Now, I already know what's going through every single one of your minds right now. I got to sell all my bonds. Don't do that, all right? That's the worst thing you could do. But this is a good example of some of these complexities, some of these risks that we have to face. This is the reason why you don't sell your bonds, all right? This is a chart of the drawdown of the S&P 500, this light shaded area here, over the last, 20-something years, 20 years. As you can see, this is the dot-com crisis, okay? The drawdown from the peak price of the S&P 500, and here's the financial crisis. Notice how far down it goes, 50% from highs, and the duration of how long it's below before its peak, right? It could be years, all right? Bonds, the worst year in bonds has been like 4.5%. It's nothing. It gets paid back quickly. Or not gets paid back, recovers quickly. My point here is that bonds are used not just for coupon, they're used for diversification. So if you're saying, oh, I'm going to sell all out of my bonds and go into, cash or stocks or whatever it may be, we're seeing that, by the way. We're seeing a lot of exiting the bond market into stocks right now. The cure can be often worse than the disease. All right? We don't want to screw around diversification. The answer is not to sell out of bonds, it's to change your strategy. I think those investors right now that are passively invested in the bond market right now, buying index funds, are in a world of hurt, or are risking a world of hurt going forward, which is the reason why I'm using active managers in fixed income specifically for this reason, is I think there are a lot of landmines in the fixed income market, and I'm using some professionals to make sure I don't run into them. Because this passive investing movement is a bit of a concern to me. This is not an active manager ripping on passive. That's not what's happening. I love passive investing vehicles. I use them myself. What I'm saying is that, I'll just show you. There's a survey the Capital Group did, one of the largest asset managers in the world. They did a survey showing a huge mismatch. They said protecting gains is a priority. I think that's pretty right? We don't want to take those drawdowns like we saw in 2008. So most investors, 50 years and above, 80% of them value protecting gains. Protecting gains is a priority, all right? That same group, 53% of them, had no idea that index funds expose them to the full ups and downs of the market. Think about that. So I'm an investor. I say, you know what? I'm tired of paying for active management. I'm tired of it. It's too expensive. I'm going to these passive Vanguard funds, which I love Vanguard funds. But I'm going to put all my money into a passive vehicle because I'm tired of paying it for active management. Market's going up. Everything's great. What they fail to realize is that if the market goes down 40% tomorrow, they're taking that ride. And 53% of the people that are in these funds right now have no idea that could happen to them. They didn't read the instruction manual, basically. This is a risk because what happens is when they start going down, what do you think is going to happen? They're going to panic sell. And they're going to be throwing gasoline on flame. Now, none of you are going to do that because you did my Volatility Primer earlier. You know you're not supposed to do that. But not everybody's heard me talk. So, this is a concern of mine. This is a risk, something that we have to face right now. Now let's talk about some fun stuff. And then I think I'm done. Yeah, I got to hurry. All right, so technology is what we call accelerated growth. Think about what we've seen in technological progress over the past couple years. We're going to get these slides out to everyone, I believe. This is a cool chart. Here's the printing press back in 1400, right? And then we got the steam engine, we got the telephone, the car right here, and then, boom! This is like the last 5 years, all right? And it's going to go straight up from here. The technological changes that we have seen have been absolutely staggering in the past 15 years. They're going to get even crazier going forward. And as an investor, I think the world is changing a lot, and I am positioning a lot of my portfolios to benefit on the entrepreneurship and innovation that is changing the world right now. Think about energy here in the US. We are a net exporter of energy. We are the world's largest energy producer, both in natural gas and in oil right now. Think about how crazy that is. In 2007, when oil was, what, 150, 160 a barrel? If somebody sneezed too hard in downtown Baghdad, the price went up 15%. We were so heavily dependent on foreign oil. Today, no big deal. We produce more than enough for our need. And that's just getting better every day. What's running rigs today are computers. All right, we all know what technology does to the cost of production. So we got to focus a little bit here. Computing, this stuff is amazing. Cyber, artificial intelligence, big data. The technology is absolutely amazing. Has anybody read about this Google quantum computer that came out a couple months ago? This computer, which by the way looks beyond creepy, it's out of a sci-fi movie. And like if Apple produced this, it would be like have a nice aluminum case or whatever. No, this is Google here. This computer performed a calculation that would take the fastest computer on the planet right now 10,000 years to do. It did it in 2.5 minutes. That's unbelievable. Think about what they're going to do with this thing. I mean, maybe it ends up, being like a Terminator movie, but hopefully not. I mean, this kind of stuff we want to pay attention to. Transportation, self-driving cars. In about 2 years ago, I was in Pittsburgh. I landed that day. I heard on the news that Uber that very day started doing driverless taxis from the airport to downtown. And think about how amazing that is. You can get in a car, they're going to drive you downtown in Pittsburgh. Now, obviously, I didn't do it because I'm not insane, but I thought that was pretty cool. I mean, think about where this technology is going. And then biotechnology. Do we have any doctors in here? Good. All right, because I have an irrational fear of needles. I never went to med school. But what is happening in oncology and cancer research is absolutely unbelievable. They are stopping cancer in many instances right now. What used to be, frankly, a death sentence is turning into real hope. Has anybody heard of CAR T technology? This stuff's unbelievable. So apparently, this tells you how bad I am with medical stuff. So these things in your body is called T cells that fight disease, right? So the reason why cancer grows in your body is because it tricks the T cell into telling it it's not that bad. All right, so the T cell sees cancer growing, no big deal, I'm moving on. So some really smart people in Boston a couple years ago said, hey, why don't we take a couple T cells out of a body, put it in a test tube, retrain them to say, hey, cancer's bad, go tell your buddies. Put those T cells back into a body, talk to the other T cells, and what do you think's happening now? It's eating cancer away. Your own body's natural defenses are finally turning on and learning how to kill cancer. All right? If we have a recession, let's say I'm dead wrong about my forecast tomorrow, and we go into recession. All right? This stuff up here is not stopping anytime soon. This is recession-resistant stuff. We're not going to stop curing cancer because the market got hit. So as an investor, I like to position my portfolios to take advantage of some of these key themes rather. And what's the coolest thing about all of this happening? What country is home to the most of this entrepreneurship and innovation in the entire world? What country? Right here, right? Go US. China has some.
No, they just copy what we do.
They do. Well, a lot of it's copy. Yep, no question. There's a lot of copy, but there is a lot of money right now being invested in those companies. But for the most part, the overwhelming majority is coming here from the US. There's some in Israel, there's some in other parts of the country, in other parts of the world, Korea, for example. The overwhelming majority is here. I mean, look, my family's Italian. I love Italy. I love going over there. But frankly, I can't tell the difference between a Tuesday and a Saturday. All right, nobody works over there. There's no innovation coming out of Italy. It's wine and cheese. That's it. I mean, what's come out of Europe in the past couple of years? Spotify. All right, great. I can get music on my phone. I mean, I'm ripping on Europe for a reason. Zero innovation. All right, it's all here. So as investors, we have a tremendous opportunity to position ourselves to take advantage of some of this. So I could keep going, but I need to stop because I know I ran over a little bit. So I want to thank everybody. I will take questions as long as I'm allowed to. I will answer any question you may have if I can. Yes?
Back to your negative bond rate.
Yeah.
Who would buy it?
Very good question.
I mean, I don't understand.
No, believe me.
People would do it.
So there are a couple buyers of negative bonds. So Europe's a bit of a scam right now. That's the short version. So the regulators in Europe say, okay, or the European Central Bank, they basically regulate the banks and say, banks, you have to own a certain percentage of super safe bonds. It's kind of like what the Fed did here with our banks. So they say you have to own a certain percentage of bonds that are risk-free, okay? So then the banks have to go out and find risk-free bonds in Europe, which don't really exist outside of government bonds. So then the governments say, wait a minute, there's a natural demand for our bonds. So they sell bonds like from Italy and Greece, even believe it or not, Greece, who just sold a 10-year bond for 0%. All right? That doesn't make any sense. It's a scam. So the regulators say, banks, you have to buy this debt. The banks are saying, well, wait a minute, you're telling us we have to buy debt with a negative interest rate, we're going to lose money. They say, well, yeah, but it's risk-free. It's crazy. So that's one buyer. The second buyer is somebody who thinks the rates are going to go more negative. So you have traders, speculators. So if something's trading with a negative yield of, let's say, 0.5%, if I think that negative yield is going to go down to negative 1%, I'd buy it and flip it. So that's the other type of buyer. Those are really the only two buyers. That you are
Just buy a CD. At least they're going to get a little bit of interest.
preaching to the choir. I think these people are running in front of a steamroller to collect a dime. It doesn't make any sense to me. I think a lot of the buying is forced buying. Another type of buyer, the third type of buyer, is somebody so terrified to put their money to work anywhere else. What's going on right now in these negative interest rate economies? I think one of them is just now starting to switch. I think Sweden said that they're going to start moving back a little bit because they don't know what's going to happen. It's a very, very difficult scenario to understand how somebody can view an instrument with a negative yield to be risk-free, particularly an economy like Italy or Greece or Spain. I mean, their 10-year yield, the yield on their 10-year bond, treasury, their government bond, is lower than the U.S.'s. Financial theory says that doesn't make any sense. The U.S. is way, way less risky than Italy. So why would their bonds trade less? It's all rigged over there. So that's the reason why I don't like negative interest rates. You have a very good question, and it doesn't make much sense, but there are some people that are buying it for speculative purposes, or they're required to because of regulations. I already know like the 3 or 4 questions in everybody's mind right now.
How do you think talk about policy versus politics, the new tax policies as they play out in the next couple of years and shift what we would need to?
So the question is how the tax changes, okay? The 2 tax changes that happen, corporate and personal. I can't talk much about personal, unfortunately, because it's very, very unique to each person. Some will win, some will lose. But I could talk a lot about the corporate tax. Now, it is, I think, probably the single most important thing that has been done for our country in the past 20 years was fixing our corporate tax code. This is not a Republican thing or anything like that. What I'm talking about is think about a company like Accenture or Pfizer. Pfizer, big drug company. Familiar with them? Yeah, they're no longer a U.S. company. They moved. Accenture left for Ireland. We've started to see companies leaving the U.S. over the past 10 years because our corporate tax structure was insane. Any small business owners in here? Now, Sean and his team will tell you. Running a small business in this country up until last year was very, very difficult because of the way the taxes worked. We were very anti-competitive for corporations, and furthermore, there was about $3.5 trillion in foreign bank accounts that companies refused to move back to the U.S. because they get taxed on it. So they changed the corporate tax code, and it has been a game changer for our country. Now, the opposition to this will tell you that it was a one-hit wonder. Well, they just, they did the dead stock buybacks. They raised wages one time. In fact, that's garbage. When you move a corporate tax rate down the way you did for small businesses, especially for small businesses, it changes everything because they can finally go out and hire more people. They can make more money themselves. They can incentivize other people to start small businesses. It is a big, big deal. If you look at competitiveness rankings in the world, that alone propelled us to number 1 and number 2 spot in almost every survey you're seeing right now. It's us in Singapore. Many years ago, we were like 8 or 9 on the list, sometimes even lower. So I think it's been a very, very good thing for our economy. I think it's going to be huge going forward until the politicians screw it up. They will at some point. Not Republican or Democrat. They work together on this one. All right? Both parties will figure out a way to screw it up. But I think it was a very, very good thing for our economy. Yes?
What's your opinion about U.S. going to have a negative that all the countries are doing it, eventually U.S. will go the same route.
I don't think they will. They could. So the question is, will the U.S. have negative interest rates at some point? I think it's very unlikely. The Fed, I think, in my opinion, is watching other countries try this out, particularly Japan and parts of Europe, and it's not working. It's not working at all, and I think they're saying there's no real reason to drop our rates negative. Now, what I could see happening is because, think about it this way, because interest rates are negative in other countries, what happened this year? Why do I think the Fed lowered interest rates? Is because you could earn a negative interest rate in a German government bond, a negative interest rate in an Italian government bond, or you come over here and have the safest bond in the world and earn 2% on a 10-year treasury, or 2.5%. So negative, 2.5%. This is going to win, right? So what happened? Foreign capital all over the world this year jumped into the government debt here in the U.S. And when that happened, because when bond prices go up, the yields go down. And that's the reason why we saw the yields on Treasury securities, particularly the 10-year, come down this year. So is there a scenario where the Fed dips into negative interest rates? I think it's highly unlikely. Is there a scenario where the 10-year Treasury dips negative? It would take a phenomenal amount of foreign capital to come in and push that rate lower. Now, Trump has said that he thinks that we should have negative interest rates because other countries, and I could see why he thinks that, but I think it's a really, really bad idea. Really bad idea, because Trump's short term. What does every first-term president want? A second term, right? So he's saying that because he wants to make sure the economy is strong through November of next year so we can win. The ramifications of negative interest rates over the long run make me a little nervous. So I'm a little off subject. I don't think they're going to happen here. I really, really don't. If they do, I think there are going to be bigger problems that are happening.
I hope they don't.
I don't. Yeah.
Powell has some idea, smart. And
Yeah.
Trump after him all the time. I feel sorry for him. But
Yeah. Trump can't do anything. Powell is untouchable for the most part. He can't get fired. I know Trump wants to fire him. He talks about it. By the way, this has been going on for 300 or 200 years in our country. All right, the president and the head of the Fed have fought since the Fed existed. And before the Fed existed, the main banks in this country always fought with presidents. It's a constant battle because the Fed, they can, it's like with Clinton back in the late 90s. He got reelected and he basically had to get bond traders behind his back. That's what gets a president reelected is the economy, usually. We'll see what happens next year. Yeah.
What's your sense of the national debt?
I knew that was going to come up. All right. How much time do I have? I'll give you the short version. Okay. All right. Don't throw anything at me.
What was the question?
I'm sorry. What do we think about the national debt, the government debt, the U.S. government debt situation? $22 trillion, I think. Is that right? All right. So I don't like it. I think it's insanely stupid that both the Democrats and Republicans have spent this much money. It's fiscal stupidity. That being said, it's not a big deal. So let me walk through this before you throw anything at me, all right? This is typically the time when the crowd turns on me. So it's not the size of the debt. We talked about that earlier, right? It's can we afford our interest payments? And if you look at the accounting for the U.S., we can more than afford our interest payments right now. Our debt service as a percentage of the income coming in is almost the lowest it's ever been. So my point is we're a very wealthy country. We can afford the debt from that perspective. A couple other key points I want to mention real quick. Let's say, for example, have you heard this whole story about, well, China owns all of our debt, so one day they're going to make us learn Mandarin in our schools and everything, right? It doesn't work like that, all right? First of all, China only owns about 6% of our debt. 2/3 of U.S. government debt are actually owned by U.S. citizens, corporations, and government agencies. So when we're paying interest back to ourselves. 6% is not that much. And furthermore, let's say we decide not to pay. Let's say I'm wrong and we default on our debt. What's China going to do? They're going to come over with a barge and be like, yeah, I want the Statue of Liberty. It's not collateralized against anything, right? That's government debt. It's on the full faith and promise or whatever the wording is for it's like, yeah, we're going to pay you back. That's all it is. So that's not as big of a deal either. And frankly, there's such a strong demand right now for U.S. debt that Trump is technically speaking right. We could massively increase the amount of debt we have in our country if we wanted to, because there's going to be a buyer for it for a long time. I hate that idea, by the way. But we could, the demand is there. The best explanation, I used it earlier when I was talking to the team here, I could think of is imagine Bill Gates, right? He's worth $100 billion. Imagine Bill Gates wakes up every single day and buys a $500,000 Lamborghini, all right? And just drives it into a river. Wakes up the next day, does the exact same thing. $500,000, river, $500,000, river. Does this every single day for his life for the next 30 years. Is that smart? No, it's a waste of money. Plus, it's an awesome car. Why would you drive it into a river? All right? But can he afford to do it? Yeah. We're a very wealthy country. Look, the spending is insane. It's gotten out of control. Democrat, Republican, they're both to blame, all right? But it doesn't affect your investments, at least not now. And it probably won't for decades. So stay upset about it. Vote people out of office if you don't like them. But don't let it impact your investing. It doesn't matter. Government debt is really, really weird. It's not like debt that you and I have. Good. I'll keep going. I mean, it's up to you guys. Yeah. Yeah.
And the alternative to that was to increase the economy, right?
Well, it depends on what you're talking about. If you're talking about if they want to devalue the debt, you could do something called monetize the debt. So let's say we owe a lot of money and we can't pay it back. What we could do is we could actually print more money and then pay it back. It's been very popular in Venezuela over the past couple of years. Yeah. I don't think we're going to end up doing that, truthfully. It could happen. So going back to the question about the government debt, let's say we did get ourselves in a predicament. We could do that. Now, our bondholders would not like that, because you're right. What that would do is that would cause the value of our currency to fall, theoretically speaking. So that would upset them. But, what are you going to do about it? We're the bully in the schoolyard. I hate to say it, but there's no court they could take us to. Like I said, I think that's an extreme outcome. I don't think that's going to happen. But theoretically speaking, if we had to, that's called monetizing the debt. I think that's highly unlikely. Typically what happens when debt comes due and we don't have enough money to pay it back, they just issue more debt. It's called rolling debt. So corporations do this a lot. Like Verizon is a company that probably has a lot of debt in their balance sheet still. AT&T. They have debt that comes due every single year, probably every single month. And rather than actually go into their bank account and hand the cash back, they just create a new bond, take that money, and just pay back the old bondholders, and they roll the debt. There's nothing wrong with rolling the debt as long as you don't get carried away with it. A lot of companies do that. A lot of countries do that. Yes?
I'm naive, but can another government devalue the dollar? China?
Can China devalue our dollar? Not really. Now, there's a fear out there that China, since China owns all of our bonds, if they just sold all of them at once to get back at us, it would cause the value of our currency to fall. Theoretically, that's true, but the problem is if you sell one currency, you have to sell one to buy another one, right? So let's say you go to France, right? You go to Paris for the week or whatever. You sell dollars and you get euros, right? Does that make sense? So if China wants to sell US dollars on the open market, they got to buy something with it. And there's no currency on the planet that is as abundant as the US dollar. So they couldn't sell their entire treasury holdings, dollar holdings, because they would have to buy pretty much all the currency on the open market to replace the amount of dollars that they own. So theoretically speaking, it could weaken the currency, but in practicality, it's impossible for them to actually do that. Plus, since they do a lot of trade with us, they want to make sure they have dollars. Another reason why the US dollar is so strong it's the world's reserve currency, is that it's actually what's being used in global trade. So if I'm Vietnam and you're Saudi Arabia, you don't trust my currency and I don't trust yours. So we transact that. If I buy a barrel of oil from you, we do it in US dollars. Almost all of global trade is done. It's like 70% of global trade is done in US dollars. Right around 2% of global trade is in Chinese currency. 2%. So even if China wanted to take over us as the world reserve currency, it took us 8 decades almost to get to where we are. There's too much faith and history behind using the dollar. There's no way that's changing anytime soon. It would be a near miracle, in my opinion, for China to capture 6% of global trade in the next decade. That would be a massive, massive move. And they've got so many problems right now internally with their own debt that I can't imagine a scenario where that would happen. But there's a lot of that conspiracy theory stuff out there, yes.
Besides 2 points of the Chinese renminbi, their policy is so bad that they don't let money out of the country.
Well, that too, you're exactly right. 50,000 won a year. Yeah. So, if you want to take money, so how are they getting money out of the country? So I live in the Bay Area. I just moved to the Bay Area recently, and there's a lot of Chinese money and foreign money coming in to buy all the real estate. That's why the prices have gone up. One of the reasons why the prices have gone up. So what the Chinese buyers are doing is they are moving 50,000 won out themselves, and then they have all their relatives move 50,000 out a piece. And what they really get creative doing is that they actually ship suitcases of cash to relatives here in the U.S. Cash in a suitcase to get the money out of the country because their banking system won't allow it. Take a guess what else are they using?
See,
Bitcoin. Yeah.
when they trade with Turkey, they are using Chinese renminbi now.
Yeah.
The Russian, Chinese push Russia to use renminbi, but Russian don't like it. But we, US dollar, we drop them because we sanctioned them. That's why.
Yes. So it's being like an us versus them thing. So China and Russia didn't get along for a really long time. And over the past 4 or 5 years, they've gotten along because we basically have made it very difficult for Russia to sell natural gas. We put sanctions on them and put that in place. So Russia wants to get away from anybody that does too much business with the U.S. So they just struck a huge deal with China. They built this huge pipeline they're about to turn on, right? So as a result, anybody that does business with China's kind of like that lender out there right now saying, look, we'll give you money for whatever you want. You just got to do everything we tell you. So if anybody needs money right now, China will step in and provide money to that country. Venezuela is a good example. Brazil is a good example. Typically non-extradition countries with the U.S. because you're right, they want their currency to be used more in global trade, but they have so many restrictions on it that it just can't take off. Like, you can't tell me a U.S. citizen or a U.S. national corporation is going to start collecting renminbi or won in their bank account because they're going to start doing global trade in Chinese currency. That is not going to happen. Now, Africa might do it. Russia's going to do it to a certain degree to make them happy. Maybe Brazil, Venezuela, but you're not going to get the European Union to use it all that much. Definitely not the U.S. If you look at reserve currencies in the world, about 65% of the world uses U.S. dollars in central banks.
Was 59. That's close.
Okay. And then about 21% of the world, 21% of world reserves is the euro. So, and everything else is a lot smaller. So as you can see, the rest of the world could join together and create some new currency, all right, and call it the non-dollar, and it's still not going to be used as much as the real dollar. This is, like I said, these types of things take years. It's like network effects, like Facebook, right? Or Google. Everybody uses Facebook, right? So that's the reason why they're so dominant is the network effects. Everybody uses the US dollar. For somebody to use a new Facebook, everybody would have to take all their photos off and all their stupid messages, whatever they do, and then put them on a completely new platform and start using that platform instead. And then assume that all their friends are going to do the exact same thing. Network effects are incredibly powerful things. And the network effects around the US dollar are as strong as they can get. I'll keep going. Up to you. All right, thank you.